It started with a quiet message across trading terminals. China was canceling all U.S. soybean orders, effective immediately. By noon, 2.4 million tons were rerouted to Brazil. By sundown, $1.1 billion in U.S. farm contracts had vanished. 40 cargo ships, mid-ocean, suddenly found themselves without a destination. This wasn't a simple glitch or a misunderstanding. It was precise, swift, and devastating. Big names like Cargill, ADM, and Bunge were blindsided. Bloomberg called it an unprecedented rerouting of agricultural trade. Wall Street traders scrambled to adjust futures contracts, and Pentagon analysts raised quiet alarms because food security and trade flow stability are considered matters of national security. One farmer in Iowa put it bluntly, "We weren't just cut off, we were cut out." Soybeans aren't just a crop, they're a symbol of America's agricultural might. The U.S. exported over $14 billion worth of soybeans to China last year alone. Losing that market, even temporarily, sends shockwaves throughout the Midwest, affecting not just farmers, but entire rural economies that depend on stable agricultural exports. And the ripple effects didn't stop at the farm gates. Commodity prices on the Chicago Board of Trade dropped sharply, wiping out hundreds of millions more in market capitalization. Equipment dealers, seed companies, and transportation firms linked to agriculture immediately felt the pressure too. How many local banks that lend to farmers are now suddenly exposed? How many main street businesses that depend on farm incomes will start seeing fewer customers walking through their doors? These are the hidden layers of economic damage, layers that don't make the headlines but could quietly reshape the American heartland. So, if China can sever billion-dollar ties without hesitation, what message were they really sending? And if soybeans could be turned off like a switch, what else could? Part 1. A calculated strike, perfect timing, perfect target. Timing, as always, was everything. March through June marks the U.S.'s most profitable soybean export window. Canceling now inflicted maximum pain with minimum cost to China. Meanwhile, Brazil stood ready. Over the last 5 years, Brazil's soybean acreage expanded by more than 21%, backed by strategic Chinese financing. In fact, over $11 billion was invested into upgrading ports, railways, and storage facilities, long before today's headlines. Some trade analysts believe these moves began during Trump's presidency, when tensions between the U.S. and China first started escalating. The groundwork was laid slowly, methodically, so that when the moment came, China could pivot without disruption. They even paid premiums, $14 to $22 more per ton, to secure Brazilian soybeans instead of U.S. ones. Now, ask yourself, would any nation willingly overpay unless they were playing a much longer game? And it's not just about paying more. It's about proving a point. China was willing to lose in the short term to win bigger in the long term. In the chess game of global economics, sometimes sacrificing a pawn opens the way for a checkmate. Consider this. Brazil wasn't just lucky to be ready, they were prepared by design. Between 2020 and 2024, China poured billions into Brazilian farming regions, financing not only production, but also transportation. Grain corridors, railways like Ferrocarril, and even port expansions at Santos, all funded with the future in mind. And when the moment came, they acted with surgical precision. No delays, no scrambling, just a clean pivot away from American supply. It raises a deeper question. If China can engineer this kind of strategic realignment over soybeans, what sectors might they be planning to decouple from next? Part 2. Building power through ports and railways. Most people see soybeans. Strategists see logistics. Over $8.3 billion invested in Latin American logistics wasn't just about buying food, it was about owning the lanes through which food moves. Brazil's Port of Itaqui expanded with Chinese investment. The Northern Grain Corridor rebuilt and expanded with Chinese financing. The Ferrocarril Railway designed to slash transportation costs by up to 35%. By embedding themselves into Brazil's agricultural arteries, China achieved something even more critical than cheaper soybeans. They built resiliency into their supply chain and reduced U.S. leverage over their food security. When you control the flow of goods, you control influence. You can redirect shipments, set prices, and dictate terms. And once infrastructure is in place, reversing those investments is nearly impossible without massive disruption. Let's put it this way. Controlling a port isn't just about unloading soybeans faster. It's about deciding who gets priority. It's about creating strategic choke points, quietly but permanently. And there's another layer. Much of this investment is quietly tied to the BRICS agreements: Brazil, Russia, India, China, and South Africa, a network increasingly aligned to operate outside U.S. influence. The ultimate goal seems clear: reduce exposure to American-controlled shipping lanes, financial systems, and regulatory frameworks. And if that's the plan for agriculture, how far behind could other sectors be? Infrastructure isn't just roads and bridges. It's a battlefield, and China is building fortresses where America still sees farmland. Part 3. It's not just soybeans, corn, wheat, and beyond. While soybeans dominate the headlines, corn has been quietly slipping away too. U.S. corn exports to China fell by nearly 29% year over year. At the same time, China inked a massive 3-year corn import deal with Brazil, covering up to 9 million tons annually. The Chinese government also auctioned off 1.2 million tons of U.S. corn reserves, citing price instability. But behind the headlines, the message was clear. Beijing no longer trusts American agricultural supply chains. And it doesn't stop at corn. Analysts warn that wheat, sorghum, and even cotton could be next in China's gradual realignment. The consequences are not just rural. A collapse in farm incomes ripples outward, hitting banks, supply companies, and even the real estate sector in farming communities. Already, 11 Midwest states have been classified by the USDA as being at moderate to high risk of farm insolvency. Rural banks are tightening lending. Small-town businesses are closing earlier than expected. And in places where agriculture forms the backbone of the economy, the dominoes are already falling. A 2025 survey from the American Bankers Association found that farm loan delinquencies have risen 14% year over year, the highest rate since 2016. How long can these rural economies hold on if export markets keep evaporating? And beyond the economics, there's a political undertone too. Many of the states hardest hit by these agricultural shifts are also key battleground states in U.S. elections. Is this economic pressure purely incidental, or could it be another strategic front in a broader, quieter contest for influence? Part 4. The bigger play, testing the system itself. This isn't just about food anymore. It's about strategy and signals. If China can walk away from $14 billion worth of U.S. soybeans without blinking, what's next? Semiconductors? Rare earth minerals? U.S. Treasury bonds? Already, concerns are rising. China holds over $775 billion in U.S. Treasury securities. If even a fraction of those holdings were shifted, the shockwaves would be felt globally, spiking interest rates, devaluing the dollar, and destabilizing markets. Could that be phase 2? Think about it. China demonstrated they can reroute supply chains. They showed they can absorb short-term losses for long-term gains. And they proved they can make massive economic moves without causing panic at home. But even deeper than that, they're showing they can act without warning. No statements, no debates, just action, decisive and irreversible. That unpredictability is a weapon itself. If other countries and investors begin doubting the reliability of U.S. markets or supply chains, the erosion of American global influence could accelerate. Former Trump administration officials repeatedly warned about this scenario. Diversify supply chains, rebuild domestic industries, reduce dependence. Now, watching China's maneuver over soybeans and corn, one must wonder, was the warning loud enough or already too late? And if the dollar is the next target, will America even see it coming?